We're going live. And we're live. Okay. Welcome back, people. Looks like all the hiccup has been fixed. So let's jump straight into it. So this is episode 2 of our popular investor series. So last week we started with episode 1, so our slides need updating. Sorry for all the bumpiness. I'm a machine learner on Etoro. I'm an Etoro popular investor, and the main idea behind the series is to help surface PIs on Etoro who are probably not getting much look at. So basically, I'm looking at using different quantitative methods to help surface PIs with interesting statistics. So all comments are again welcome, and I'm looking to refine the process over time. So the methodology is just as last week, basically using data from Etoro's PI chart. This chart is what sort of mimics an investor who invests and forgets for 6 months. So this does not take into account if the PI injects any cash along the way. And basically, it tells the results in favor of PIs who are copier friendly. So a PI might inject cash, but if the PI is copier friendly, what they usually do is they rebalance your whole portfolio. So copiers do not have to also inject cash. The PI just rebalances the portfolio and makes sure they're capturing everybody. Again, the main idea is to help surface interesting PIs, so it's up to you to do most of the due diligence from here on. So let's go definitions. These are definitions you should already be familiar with. Basically, we are looking at the risk-adjusted metrics. So we want to take into account how well you're doing and normalize that by sort of risk factors. So the first one we called ROMAD. So we're looking at total return over the last 6 months, and we are normalizing that by your maximum drawdown over the period. So for each unit of drawdown that you force your copiers to incur, what is the return that they've had over that period? The second one is the Sharpe ratio, which is also a normalized return measure, which basically answers the question, for each unit of volatility or fluctuation you force your copiers to go through, what is the return that they had? Sortino is similar to Sharpe, but then instead of looking at total portfolio volatility, we just look at downside volatility. And the last one, in terms of risk-adjusted return measures, is the benchmark alpha. So basically what I ask is, for the return that the PI earned over the last 6 months, what fraction of that can we say did not come from just leveraging up or down, variations in the QQQ, SPY, or Dow? So basically, are you doing something besides just leveraging up, variations in the NASDAQ or these other equity benchmarks? So those are the standard measures I look at, and then I sort of try to initially filter all PIs. So I don't look at all PIs, I just filter based on these benchmark risks. So the filters are basically the standard ones. First, you have to have been a PI over the last 6 months. Second, your account should have been live 6 months ago, and you should have made a minimum of 20 trades. Your profitability should be more than 50%. Your max risk score over the last 6 months should not be greater than 6. Your max daily drawdown should not be greater than 5. And your max peak to valley drawdown should be less than 4%. Where is this 4% coming from? This 4% is the minimum drawdown of the benchmark ETFs that we're looking at. That is the NASDAQ, the S&P 500, and the Dow 30. And over the last 6 months, the minimum drawdown among these 3 ETFs is 4%. So a PI who tries to beat this benchmark should have a drawdown lower than this, from max to peak, from peak to max. And your total return should also be larger than the total return, the highest total return among these 3 ETFs, which is 24% over the last 6 months. So it's I think the benchmarks did pretty awesome over the last 6 months, and let's see how many PIs out of the 1,500 PIs on Etoro match this benchmark or make it through this filter. And for this week, it's just a single individual, so which shows just how tough it is. So you should have had, I think it's mainly coming from this drawdown measure. That is what is filtering out most of the PIs. So the benchmarks did very well over the last 6 months. And the only guy who makes it through was Marino 74. And even then, if we compare his statistics to the benchmark statistics, in terms of risk-adjusted measures, he's not doing particularly well, right? So in terms of cumulative returns over the last 6 months, he's returned around 27%, which is higher than any of these three benchmarks. So the one with the highest return is the Dow over the last 6 months, followed by the S&P 500, and the Nasdaq is in third place. And Marino is beating them by around 5%. If we ask how much of the return that Marino is offering, can we say it's not coming from variations in the market? It's around 2%, so 1.79, 1.80%. So not too much, which is not surprising given that his cumulative return is not as extraordinary compared to these benchmarks. So his risk measures look very good. So in terms of volatility, it's around 10%, which is much smaller than these benchmarks. In terms of drawdown, it's similarly small, it's around 3.61, which is much smaller than these benchmarks. In terms of other risk-adjusted measures, he seems to be beating all the benchmarks, right? So in terms of the return he's giving you based on the drawdown he forced you to sit through, he's ranking up there. So for each unit of drawdown that you experience by copying Marino over the last 6 months, you get a return of around 7.5%, which is pretty high compared to the benchmarks. So the QQQ is around 2%. For each percent of drawdown you sit through, you only got around 2% return. If you look at Sharpe ratio, he's in third place, so not too good. But if you look at Sortino ratio, he's in first place. So basically, his portfolio didn't experience too much of fluctuations to the downside. It mostly experienced fluctuations to the upside. So I guess given that he's the only one who made it through the benchmark, let's take a quick look at his portfolio if there's anything we can learn, right? Is there anything that the numbers are not showing us? I believe this is his portfolio. So yeah, Marino 74. Yep, that's him. So let's see his description. So he says, hi, I'm a math enthusiast. I started trading 5 years ago. Copying other traders, but since 2017, I don't copy anyone anymore. I dedicated all my free time to Forex. I follow all the markets, waiting for the right moment to enter. In doubt, I do not open positions, and I will hardly close in red. My goal is 40 to 50% annual income, which is pretty high, right? We know the market on average is returning anywhere between 8 and 12%. So if you're shooting for 50%, you should be doing something very special. So we should ask ourselves, has he met his goal? And the answer is very much no. So you look at his initial trading history, it looks really bad. So fast 4 years, he was just losing money. And then in 2017, he made extraordinary returns, most probably due to crypto. And in 2018, he did pretty well, given the most benchmarks return negative. So he returned positive in 2018, so something special is happening here. 2019, around 11%. Compared to the benchmarks, again, it wasn't extraordinary. The benchmarks did pretty well in 2019. So you had the Nasdaq returning over 40%, if I'm not wrong. And again, in 2020, returning again over 40%. So if we look at his history, he doesn't seem to be beating the benchmarks too much. But over the last 6 months, he has beaten the benchmark. So what exactly is in his portfolio? And this is troubling, right? So he has Kronos Group, AES, NRG Energy. I don't know who these companies are. What I find troubling is in his bio, he does say his focus is on Forex, if I'm not wrong, right? So he says he has a dedication to Forex, and it seems the reason why he did pretty well over a sample period is because he's been trading a lot of these stocks. So very problematic. his bio completely goes against the results we've seen. Yeah, we look at his results, and he's mostly been trading stocks now. He hasn't been trading so much forex. So his performance now seems to be mostly coming from trading equities and not trading forex. So if you want to copy him, it would make sense for you to spend some time talking to him on his wall and find out exactly why he has switched trading strategies, and maybe get him to go into details into exactly what his new strategy is. So he doesn't really communicate a lot, given that he's a popular investor, and that's a bit troubling. So again, the whole idea is to surface interesting people. This guy is doing something interesting, so if you're a copier, engage him and do your due diligence, and then take it from there. Okay, so that's the benchmark risk results. So let's look at the high risk filter. So the high risk filter is just the same as the benchmark, but with a few changes. So you have to be a PI. Your account should have been live 6 months ago. You should have made a minimum of 20 trades over the last 6 months. 50% should be profitable. Your max risk score over the last 6 months cannot be greater than 6, and your max daily drawdown cannot be greater than 6. So the new thing here is that your peak to valley drawdown now shouldn't be greater than 16%. Where is this 16% coming from? We are just saying we're giving people room now to take risks. So your drawdown is 150% of the maximum drawdown from all these three ETFs. So we're giving people room to take risks, but then we expect them to give us a return commensurate with that risk. So now we're saying your return shouldn't be lower than 35% over the last 6 months. Where's this coming from? Again, you should give us a return that is at least 1.5 times the maximum of these benchmarks. So now high risk, what does that mean? It means we're looking at drawdown. We give you room to go into a drawdown, but then give us a return that is similar, at least matches what the benchmarks would have given us. And with this filter, we have 160 out of 1,500 PI. So that's around 10%. So that's pretty good. So let's see. Oops. Okay, I thought the results didn't come up. So let's see who made it into the top 3. These are interesting people. So in first place, we have Isbelle. In second place, we have Mexploder, who I believe was here last week. And in third place, we have SahanChowdhury. So let's just take a minute to look at, well, the interesting thing is they all completely obliterate the benchmarks in terms of risk-adjusted measures, right? So in terms of ROMAT, they're like doubling, tripling, quadrupling these figures. In terms of Sharpe ratio, they're 2 or 3 times better than these benchmarks in some extent. Sortino, similarly very good. In terms of alpha, it's also interesting, right? So they're providing very large alphas, but then if you compare these alphas to the cumulative return, you can see that a large fraction of these returns is just coming from leveraging up these positions. So if your alpha is around 11% and the cumulative is around 171%, it means just a small fraction of this outperformance is really from stock picking. A large fraction is still coming from just imaginative and very intelligent use of leverage. In terms of risk, it looks like they're taking a lot of risk to give us this return. So the volatility of the first place PI is around 50%, but drawdown isn't too bad, right? In terms of drawdown, is all less than 10% over the last 6 months. So that's interesting. So they all have drawdowns that is much less than what you would have gone through if you had held the QQQ. The problem really is the volatility. But again, if you think about it, you should expect the high volatility, right? So if somebody is giving you a return of 250% over the last 6 months, there should be a lot of fluctuations in the portfolio, but then it should be fluctuations to the upside. So that's why there's a huge difference between their Sharpe ratio and their Sortino ratio. So whereas the Sharpe ratio punishes both volatility to the downside and the upside, the Sortino just says downside volatility is what is bad, upside volatility is good. So that's why we see that their Sortino ratios are on average 2 times better than the Dow, which would be the best performing benchmark over the last 6 months. Okay, so let's I think we have time on our side, so we can hop on straight into these PI's portfolios and see if we can learn anything interesting this week. So the first place PI for this week is Isbelle. So Georgios, he has a BSc in business administration. He says 60-70% dividend stock. So this is what you should do as part of your due diligence. Do the bios really tell you anything about a portfolio that they're currently holding, or have they changed strategies along the way? And he says 10-20% stocks, speculation, 5-10% ETFs. So basically, he's holding a bunch of dividend stocks. He's also holding a fraction of much smaller speculative stocks and some ETFs to get exposures in different places. He says copy me only if you have a long-term thinking. In case there's a green month, it's normal. In case it's a red month, even better. Okay, I would say green months are good. Red months, we don't like them so much. Compounding is our employer, which is good. No risk, no reward. Wartime buyer, peacetime seller. Okay, this looks good. Let's see. Okay, he's super new on the portfolio. He's been there for slightly over a year, and during this period, his return is pretty good. So over the last 6 months, he's returned around 250%. So a huge fraction is really coming from this 40%. That is what's driving most of these results. But again, it's interesting. He's had green months over the last six months. His risk score also seems to be going down, which is interesting. Usually what we find is that they usually go up as people become PIs. Yeah, I think it's usually like that. You take a lot of risk in the beginning. You get a bunch of copiers. You realize that when there's a lot of volatility in your portfolio, copiers leave, so you respond by reducing the volatility in your portfolio, and that results in a drop in the risk score. So let's look at the portfolio. Usually what people are worried about is the invested is usually very different from the value, but it doesn't seem to be a problem here. So if you copy Isbelle, you're most probably going to get results that really mimic what he's doing. So this is the other side of the problem, right? So usually if you have like a 200% here and the invested is very different from the value, so you're going to get very different results. And usually it is also reflected here, right? So if you have like a 50% drawdown on this, you're going to get around 3% invested in the VEX, and he's going to get half of that invested in the VEX. So I guess as PIs, we should periodically try and rebalance these portfolios to bring our copiers back in line with what we do. So in terms of, I don't think it looks so bad. It could be better, but then again, these numbers are close enough. In terms of history, there isn't much I can say here, right? So this is up to you as a copier to do the rest of the due diligence. Engage him on his wall. He seems to be very communicative. So this was 10 months ago. He shared this about a month ago. 2 months ago. Okay, so not so communicative. One would expect a PI doing so well to engage his copiers much more 6 months ago. So yeah. Oh, this might be the top posts. So let's do all. And it's really, yeah, I would say engage him. Yeah, engage him. He seems to respond to copiers, and then ask for details about his strategy. If you're comfortable with it, he looks like a solid guy. Okay, in second place is Mexploder. We had him last week. I don't think we went through his portfolio. Let's do that today. So Mexploder, who is Michel Cesari, he says he's a medium to long-term investor. I plan my operations studying macro trend, fundamental analysis. I invest in industries I believe will have great growth in the coming years. No leverage, no shorts. I have a low risk and well diversified portfolio. Sustainable investing. The goal is to reach 25% profit per year. So you tell me this, and I'm like, okay, that is a bit too high. Why is it too high? It's too high because on average these benchmarks return between 8 to 12%. So if you're targeting 25%, sorry guys, if you're targeting 25% per year, yeah, if you manage to hit this like 5 to 10 years in a row, you're going to be one of the best investors in the world, if not the best. So So you can copy him from a minimum of 500, which is pretty nice. In terms of history, he's also been here not too long, so this is probably his third year. First year he lost money, that is going to get me worried. Second year he did pretty good, so he beat the benchmarks, and he seemed to have beaten the benchmarks, not using too much risk, so that is also good. We look at his annual drawdown figures, and it's more or less in line with what we're looking at, so he's not so risky, and he's doing pretty well, right? So his return is not sort of clustered within a year. It seems to have been much more spread out over the last 6 months, so that's interesting. What else is there? He loves trading BTC, Ethereum, so he seems to be a huge crypto trader. So let's go into his portfolio and see if we can learn anything interesting. Okay, so here we have a bunch of problems, right? So this is what you don't want to see. You don't want to see a 600% return, because it means if I copy him today, I'm going to have just 0.35% invested in ADA. His portfolio today has around 2% in ADA. If I copy him, I'm going to have around 3.1% in BTC. His portfolio has around 16% in BTC. So if I copy him today, so let's say even if I copied him around somewhere in December, I wouldn't expect to get the same returns as he got here, because of proportions of securities in my portfolio would be like this, whereas his would have been much closer to this. So again, PIs who want to be copier friendly should really look into rebalancing these figures to bring values closer to invested, to better help copiers get a better copying experience. So again, that means we have to discard these risk measures. So these risk numbers are based on invested, and that is problematic because we know for sure this is what drives his return. So his risk score is much higher. So Michel has a lot to do to bring his portfolio in line with copiers, but then he's doing good stock picking. So as a copier, you might want to engage him on his wall, probably talk to him and get him to make his portfolio much more copier friendly. He seems to be a much more communicative guy compared to one we just looked at, so most probably he's going to listen to you and bring the portfolio much more in line for it to be copyable. Okay, so done here. Let's look at the last person who seems to have popped. I think this is the third time I've seen him in the list, so he must be doing something special. So SahanChowdhury, let's read his bio. He says, I am an intrigued and patient trader with a long-term view. That's interesting. My goal as an eToro trader is to keep my risk score within 3 to 5 and generate the highest possible return. Okay. I always have a combination of short-term and long-term trades within my portfolio. Okay. The short-term trades are used as a way to generate excess return, while my long-term trades are generally good companies that get beaten down for a number of reasons. Example, Baba. Example, me. No, this is Baba the company. Okay, so I can go long or short in the markets so as to generate return and preserve wealth in a bear market like September 2020. Generally, I trade equities and ETFs. Because ETFs are now CFDs, I will trade them less. I may also trade other asset classes. Okay, so you open up the space for possible change of methods. So engage, ask what those changes might be. Says feel free to copy my trades, and I wish you all successful trading. This portfolio is specifically designed to generate returns for my copiers, not my main trading account. He says do not copy up in trades, so that's a new one. People usually advise to copy up in trades. And he says to copy for at least 6 months before you decide. So Sahan's returns is also one of those bulky sort of returns, right? So he's basically been doing very well over time, I may say. And he popped up on our radar mostly because he made around 56% in January, right? So this is the reason why he popped up in our radar. Because if you average out, yeah, he's doing fairly okay, but not extraordinary. It's really this January return that pushed him up the ladder. So he's going to be popping up over time, I believe, given this January return is not going anywhere soon. So his risk score is also has come down and is is within acceptable limits. His drawdowns are not too bad. If we look at his max drawdown over the last 6 months, what is it? It's around 6%. So again, not too bad. He mostly trades stocks, so he's mostly trading these blue chip AT&T, NetWest. I have no idea who they are. Apple, everybody knows. He trades a lot during the week, that is around 16. So in terms of portfolio, do we have the same? No. So his he seems to have rebalanced not so long ago. If looking at the returns he has here, so invested very close to value, but then he has a problem, not too much, right? So his BB is lost around 24%. So you're gonna get slight variations here, but then again, it's not more than 50%, so you don't have to be too worried. Let's see if we can find out exactly what he did in January that drove those fantastic returns. Well, over the last, let's see, we're looking for something crazy, right? So in January, well, there seems to be nothing crazy here. All these returns look normal, right? So how did he make 50% in January? Well, it's here. Okay, so I guess he had a bunch of BlackBerry and he closed it around, yeah, okay, so this might explain it. Okay, so now we have our answer. So he was invested in, he was so basically he was a meme stock guy, right? Okay, basically he was a meme stock guy in January when the meme stocks went crazy, right? So he had Best Buy. Okay, so that was not part of the memes. He was short in Nekula, so yeah, he's not always jumping on memes. When he thinks there's no story, he's willing to sell. But he was quick to buy game, right? So he was in the short squeeze before it happened. He jumped in again, jumped in some more. So yeah, and he jumped in reasonable prices, right? So it was never during double digits. It was always during the single digits. Yeah, pretty impressive. I'm impressed. And I believe, yeah, so he knew about the short squeeze way early, so he had very good entries and he made the best of those. Okay, so that explains it. So then the problem is you're not always going to get short squeezes of this kind. So is he going to repeat to January 2021? I doubt it. So if you're going to be copying him, you're going to copy him based on his previous results, which I don't think is so bad. But then, given that most of the results are really coming from here, you have to think twice. Again, due diligence is up to you. He seems to be a communicative person, so engage with him, get to know him, and then decide if you want to copy his portfolio. Okay, so that'll do it for today. That was the extra name. In terms of results, this is what it looks like for the high risk folks. And the benchmark risk folks, this is what it looked like. So you might want to pause it, take another look. I think I'll also put your names in the description after the video goes live. And thank you all for tuning in. I wasn't sure I was going to get concurrent viewers today, and it seems I did get concurrent viewers today. So we'll keep the series on going. If you have any comments on how I can improve the whole show, leave them in the comment section. Okay, thanks for tuning in. See you all next week. Bye bye.